Investing can be a bit overwhelming for some. This is especially the case for beginner investors. However, whether you are a beginner or a professional, you will more than likely make mistakes. For this video, it is important to distinguish between investors and traders. Investors will buy and hold on to a company stock for its future value. In contrast, traders are ones that frequently buy and sell stocks by reading the stock's price movement and market behavior. Think about day traders or swing traders. In this video, we will discuss 5 mistakes that are commonly made by investors, new and old. Before we start, make sure to like this video and subscribe to help us reach 10,000 subscribers by the end of December. Number 1. Not fully understanding the investment. Investing should be taken seriously. It is your hard-earned money. And when you invest, you must dive into some due diligence and research. Learning the business model of the company is a simple and effective way to decide whether the company is a good investment or not, based on current events. For instance, if you believe that the emerging NFT marketplace has enormous potential, then you can try to find companies that are emerging into the NFT marketplace and decide from there which company has the best company model. With that being said, a company's future prospects are important. After all, it is what they want to achieve in the near future. And if you want to invest in them long term, then you must believe that what the company wants to achieve in the future is possible and resourceful, provides a good or service that can be used by many, and can be achieved with its board members. Speaking of board members, while researching the company, you must do some due diligence on its board members. In other words, make sure the board members are adequate in their position. Would you trust a CEO with 2 years of barista experience? Why or why not? Doing research on a company's board members is just as important as understanding a company's prospect. The common saying, "You can talk the talk, but can you walk the walk," comes into play here. If a company hires half a team of boasters who have nothing to show but talks big, would you trust them to do their job efficiently? A company's vision and prospect can only be achieved by doing the work. Number 2. Trying to buy at the right time. Trying to buy into a stock at the dip is a difficult task to do. Whether you are a new investor, avid investor, or professional investor, trying to time the market is a mistake that many do. Think about it this way: if you believe the company's stock value is undervalued, then why does it matter what price point you get in it? If it is undervalued, it is undervalued. Of course, you may want to get the most out of your money. But how many more shares can you actually get if you buy the stock at the bottom? If you think the stock value will drop 50% of its value in X number of days, then are you even bullish with the stock to begin with? If you believe that you bought in at a bad time, you can always lower your average, which every investor should do. An investor invests after doing solid research on the company and board members. Therefore, when you decide to invest, you must do so with confidence and diligence. Trying to time the market indicates that you do not have the full confidence that the company you want to buy shares from will do a good job in the future. It should be said that timing the market to buy the dips is still trying to time the market regardless of what the end goal is. Thinking that it's not the right time is contradictory to your investing thesis, unless you are a stock market trader, not an investor. Lastly, it should be strongly noted that trying to time the market will most likely be detrimental to your portfolio. Number 3. Not diversifying enough. As an investor, it is crucial that you diversify your portfolio. The key feature of diversifying is the ability to reduce volatility. When a stock market correction or crash hits unexpectedly, you will not lose as much money in the process. For example, look back at the dot-com bubble crash that happened in 2000. The Nasdaq Composite Stock Market Index, ticker symbol IXIC, rose from approximately $2,600 to its peak at $5,100 in 6 months, with an immediate correction to $3,200 in 1 month. From its initial run-up in 1995 all the way to the top in 2000, the Nasdaq Composite Index Fund gave investors more than a 400% return. However, it followed a heavy crash from the top of $5,100 to a mere $1,300, with an astonishing 78% fall. If you had invested $100,000 in the Nasdaq Composite Index Fund and held through to the bottom, you would have lost a whopping $78,000. Therefore, it is important to diversify your portfolio. Even though the Nasdaq Composite Index Fund is an ETF, it tracks only one sector, that being the technology sector. If you want to diversify your portfolio, it is a good idea to invest in ETFs that track multiple sectors such as the S&P 500 or the Total Market Index Fund. However, keep in mind that when you invest in a diversified ETF, your volatility will be much lower, therefore, your risk to return ratio is minimized. This means that your money will neither grant you incredible returns nor will it force you to lose a ton of your money. Moreover, you must keep in mind that diversifying your investments does not only relate to the stock market. In fact, there are other methods of diversification. For instance, you can buy stocks in the stock market with a few investments in the cryptocurrency marketplace and manage some real estate or properties. To summarize, diversification is very important when it comes to maintaining your wealth. However, there are a few limitations that come along with it. Number 4. Trying to break even. The sunk cost fallacy is the unwilling and resistant decision to abandon their course of action, due to a heavy investment they have made. Whether this be watching a terrible movie, in a horrible relationship, or a bad investment. The sunk cost fallacy is something that happens to anyone and everyone. When you spend the time and effort into doing something, and it happens to be a poor choice or decision, it is likely that stubbornness or arrogance will try and stop you from abandoning it. It is sad to say that investing in stocks will likely garner the effects of the sunk cost fallacy. Whether it be because of the time invested in doing research in the company, or the amount of money you put into the stock. Sometimes, it is best to own up to the mistakes and take the losses. Even though it can be difficult, just remember that the stock market is a tool to initiate trades with your money. Even though a bad trade can set you back a large portion of your money, it can do the exact opposite and garner you multiple times your initial investment. The main focus of investing your money is to ensure that your money does not stay stagnant. With any type of volatility, your money will either increase or decrease, and it is important to know how much is enough. This is a lesson to be learned. Number 5. Letting emotions slip. Relating to the previous key point, letting your emotions take control over your investments is a terrible idea. With the idea of the sunk cost fallacy, you may feel that the stock market is being unfair. Perhaps because other companies in the same sector is doing well, and it is only a matter of time before you make your money back. This idea, unless backed up by solid proof and due diligence, is an investment thesis made by your emotions. The stock market does not have emotions, and you should try your best to imitate that. Even if you are a seasoned professional, emotions can be hard to tame. There is a reason why this point is so prevalent in many investors and videos. Know that, when you invest your money, you are investing in a system of trades. Do not try to beat the system. Do not let fear take over you. Do not let greed take over you. Do not let emotions take over you. This has been 5 mistakes that every investor makes. Let us know what you think about these. Have you ever made any of these mistakes? What's your story? Let us know down in the comments below, and as always, like this video if you have enjoyed it. And subscribe for more content.